I think we're going to get started. Once again, I want to welcome everybody to today's webinar on student loans. We're going to talk a little bit about some of the new developments that have happened in the last 3 weeks or so. But we're also going to focus on how to avoid default and what to do if you're in default and facing collections. So my name is Nancy Neerman. I am the Assistant Director of the Education Debt Consumer Assistance Program, or EDCAP. I'm going to be doing the presentation, but I'm joined here with my colleague and the program's director, Carolina Rodriguez. So a little bit of housekeeping. While I'm doing the presentation, if you have any questions, feel free to type them into the Q&A. The chat is going to be disabled for participants you can read the chat, but you're not going to be able to enter anything into the chat. If you do have questions, enter it into the Q&A. Carolina is going to be addressing those questions behind the scenes, and we'll stop periodically to share some of those questions and answers with the entire group. So with that, I am going to turn my video off and start the presentation. And Carolina, if you can just confirm that you can see
Yes.
the okay. So this is the agenda. We'll get to each one of these sections as we get there. But we're going to start with a little bit of information about our program, EDCAP. So we are a program initiative of a nonprofit organization called the Community Service Society, or CSS. CSS is a relatively large nonprofit that's been operating in New York for, I think, over 180 years. The EDCAP program was created in 2019 specifically to address the issue of student debt. Student debt is the second largest consumer debt in the country, with $1.7 trillion, only second to mortgages. In New York State, there are about 2.4 million borrowers that have about $90 billion worth of debt. And the program was set up for two reasons. Number one, because the size of the debt is actually enormous. And number two, because the system is very, very difficult to navigate and has become more challenging, let's say, over the last few years as different administrations try to make different changes. But we are a New York State funded operation. We offer free webinars like this with free information, but we also offer free one-on-one counseling services. So if you decide that you need help after this webinar, you can contact us, and we'll have some contact information a little bit later on and schedule a one-on-one counseling session. And we can help you do basically almost anything that you need to do within the federal student loan system. And we also work with private loans and institutional debt. But we can help you with everything from trying to figure out your best student loan options, accessing forgiveness, cancellation, and discharge programs, applying for financial aid, or consolidation, deferment, and forbearance. We act as advocates if you're having disputes with your servicer. So we'll get on the phone with your servicers or your lenders until those disputes are resolved. And we can also help you get out of debt, get out of default, and prevent things like involuntary collections, like wage garnishments, Social Security offsets, and tax intercepts, which we're going to be talking a lot about today. And then finally, if you're making plans to go to college, if you or a child is about to enroll in college, we can help you with some pre-college counseling to help you better understand how to best fund the higher education and minimize the amount of debt that you take. Okay, so we're going to start with some important updates, and I'm sure you've probably heard a lot about many of these things that we're going to talk about. We're going to talk about, I want to start with the SAVE plan and what is ultimately going to be the end of this plan. So the SAVE plan, which, as you know, was introduced by President Biden in 2023, was for most borrowers going to be the cheapest repayment option available. Unfortunately, it has faced legal challenges. And as a result of the new budget bill that just was recently signed into law, this plan is going to be eliminated. So what does this mean? If you were enrolled in the SAVE plan July of last year, when the courts basically prevented the administration from implementing that plan or charging or billing anybody in that plan or enrolling anybody enrolling any new borrowers in that plan, you would have been placed in a forbearance. It was a non-interest bearing forbearance that didn't count towards forgiveness. It is still currently in place. The forbearance right now is scheduled to end on October 31st, 2025. It's supposed to end basically when the legal challenges are resolved, and they have not yet been resolved. But the administration made an important announcement recently that indicated that the 0% interest rate is going to be gone as of August 1st. So as of August 1st, if you're in the safe forbearance, interest is once again going to be accruing on your accounts. Now, that doesn't mean that you have to make a payment. You're still in forbearance at least until October 31st of 2025. But it does mean that you are no longer in an interest-free forbearance. We estimate that there are about 7.7 million borrowers who are still enrolled in the SAVE plan. The administration is basically telling people to transition to other plans over the coming months. It's not 100% clear when the forbearance will end if the lawsuit still has not been resolved by October 31st, 2025. There's a possibility that they may not extend the forbearance beyond that date. But once again, if you're in the forbearance, you do not have to leave, but just recognize the fact that that you will at some point have to transition out of this plan, and that interest will begin to accrue in August. Okay, so let's talk about the new bill. I'm calling it HR1. This is also known as the you may hear me refer to it as the big bill. It's the bill that really implements new tax and spending cuts in a lot of different areas, and it's going to introduce some sweeping changes to student loan systems. Which are going to be implemented over the next 1 to 3 years. And those include things like new borrowing limits, new repayment options, changes to IDR forgiveness programs, elimination of short-term relief programs. I do want to be clear for anybody here that's pursuing public service loan forgiveness. The new bill does not really change the public service loan forgiveness program in any meaningful way. PSLF is its own law. And that law currently stands. There is another process called negotiated rulemaking, which happens within the Department of Education, that is trying to perhaps make some changes to the definition of a qualifying employer. But depending on how that goes, the outcome, any changes that would be implemented would not be implemented until next year. We're going to talk in a lot more detail about some of the aspects of the new bill, including PSLF. And we're going to be doing that in a webinar next week on July 30th at 12 o'clock. When you get the deck, and you will get this deck after the presentation, you can click on the link to register if you want to hear more about that. But I am going to go into, I am going to highlight some of the key changes, just so you're aware of what's coming down the pike before we get into default and collections. So one of the things that's going to be changing is borrowing limits, and let's go through this kind of loan category by loan category. So for undergraduate borrowing, that's for direct subsidized and unsubsidized loans, there are no changes. The current borrowing limits remain in effect once the new borrowing limits go into effect. And new borrowing limits, for the most part, are going to go into effect on July 1st of 2026. For graduate school, direct unsubsidized loans that you take out for graduate school, there are going to be some new limits. For a regular master's degree, there's an annual $20,500 limit. That's the current limit right now on direct unsubsidized loans for master's degrees, and a lifetime limit of $100,000. That would be in addition to your undergraduate school loans. For professional degrees, so if you're pursuing law or medicine, you would have a $50,000 annual limit and a lifetime limit of $200,000, again, in addition to your undergraduate borrowing. Then starting July 1st of 2026, and here's where it gets to be a little bit challenging depending on the degree that you're going for. The Graduate Plus Loan program is going to be phased out. Now, Graduate Plus loans allowed borrowers, student borrowers, to borrow up to the cost of attendance, which basically meant that you could fund your entire graduate school degree and remain within the federal student loan system, which affords you more protections and more forgiveness options, more payment options, that type of thing. Graduate Plus loans, however, are going to be phased out starting July 1st of 2026. If you're a new borrower on July 1st of 2026 and you have no existing Graduate Plus loans, you will not be able to take Graduate Plus loans. Now, the one exception is if you're currently in grad school and you've got a Graduate Plus loan that was dispersed prior to July 1st of 2026, you are going to be allowed to take additional plus loans for up to 3 years to complete your program. So you will not be shut out midstream, but just understand that your Graduate Plus loans will be subject to the new repayment options, which we're going to talk about in a minute. And then, of course, there's going to be some changes to Parent Plus loans. Parent Plus allows parents of dependent undergraduate students to take out loans to cover up to the cost of attendance for their undergraduate school. So they're not eliminating this, but the new limits will go into effect. And those limits are you cannot take more than $20,000 per year in a Parent Plus loan, and that would be for all of your children. And then your lifetime limit would be $65,000 per child, and that is between both parents. So the upshot of these borrowing limit changes are that parents and graduate students may be forced to take private loans if they're even eligible to do that to cover the funding gaps, or you may, in some instances, just have to reconsider either the degree that you're pursuing or try to find a cheaper school so that you don't have to take out as much private debt as you might otherwise would have to. And then when it comes to the repayment plans, so we're going to break this into different categories. We're going to start with new borrowers. Again, new borrowers would be people whose first loans are going to be dispersed on or after July 1st of 2026. If you're a student borrower borrowing for yourself, you're going to have two options. So all these different options now that the many options that people can apply for is going to be sort of whittled down to just two different options. You're going to be able to choose between a standard fixed repayment plan that is like paying back that's like a regular consumer loan, where the payback period will range from 10 to 25 years based on the size of the debt. Payments are based on your debt balance, your interest rate, and the predetermined payback period. And there's no forgiveness in these plans if you remain in them throughout the life of the loan. You just pay the loan off with all the interest. They'll be able to choose between that and then a new income-driven repayment plan or new income-based repayment plan, which is called Repayment Assistance Plan or the RAP plan. It's got a different calculation than any of the existing plans. So it's going to calculate the payment at 1 to 10% of your adjusted gross income. That payment's going to be reduced by $50 for each dependent that you claim on your tax return. The minimum payment is $10 versus currently you can get as low as a $0 payment if you have no income and your income is extremely low. Spousal income, if you're married, can be excluded for the purposes of calculating the payment when you file your taxes separately. So that's actually a good thing. In this new plan, there's no protected income as there is under the current IDR plans, and there's no adjustment for inflation. And then one of the positive aspects of this plan is that unpaid interest will not accrue. So this is similar to one of the features of the SAVE plan that they're getting rid of. If your payment does not cover, is not big enough to cover the interest, that unpaid interest will not build up on your account. So basically your loan balance will not increase. It may not decrease if you're not paying enough, but it will not increase and balloon as it has in the past. This plan will be eligible for public service loan forgiveness, which is a 10-year path to forgiveness. If you don't have the employment requirements to be eligible for PSLF, you can get forgiveness in this plan after making 30 years of qualifying payments. That's Under the current income-driven repayment plans, it would be 20 to 25 years to get this kind of forgiveness. Now, for new Parent Plus borrowers, again, these are Parent Plus borrowers that are taking out their first loans on or after July 1st of 2026. Those borrowers are not going to have access to any income-driven repayment plan. They're not going to have access to the RAP plan. They're going to have to pay the loans back in a standard repayment plan, which means that basically there's no path to forgiveness for new Parent Plus borrowers. So we're going to be going into all of this in a little bit more detail in our other webinar, or you can always contact us if you are a Parent Plus borrower and you're concerned about what to do going forward. Now, for
Nancy, sorry to interrupt you. If you can go back to the previous slide, because there were a lot of questions, and I want you to just like emphasize a couple points.
Sure.
Um, I think if you can clarify a little bit more, like the interest subsidy. So the question was, is there a loan where you're not charged interest? And I provided an answer there, but if you can explain that, and if you can emphasize how these features are related to the plan versus just the general loan by loan, if that makes sense, especially with the 20 to 25 year and now in the RAP plan 30 forgiveness and the interest accrual.
Okay, well, in terms of the interest, it's not that you will not have an interest rate on your loans. You will have an interest rate on the loan, and the loan every month there will be a portion of your payment that will accrue to that will be paid towards interest. So let's say you have a 5% interest rate on your loan. Let's say that the payment that you're supposed the payment that you're supposed to make under the RAP plan is $100, but let's say for instance that the actual interest is $200. You make your payment, the $100 payment. It's applied towards interest, but you're not making enough to cover the entire interest. In the past, what would happen is that $100 that didn't cover the interest would be added to your account balance. Under this current plan, that will not happen. So basically you'll pay your $100, but you're not going to see your balance increase because you weren't able to pay the entire amount of the interest. So I hope that clarifies that. And then I'm sorry, Carolina, what was the second question?
Um, I think the other feature, and now I'm like just chiming in because I was answering more questions. There is a lot of questions about forgiveness timelines, and the forgiveness timelines, whether it's
Ah,
20, 25 years or 30 years, is dependent on the type of plan you have.
right.
Now, I don't know if you're going to cover this later on, so I don't want to like get ahead. But you want to understand that if you should not be losing credit that you've already gained for the 2025 year forgiveness if you switch plans. But be clear that if you want to retain the 2025 years, we are recommending people look into the IBR because that is probably the one plan that is going to allow you to continue to do that. However, if you switch into the RAP plan, we can expect that the forgiveness timeline could get extended to 30 years. That plan is still not available. It should be available by July 1st, 2026. So just be aware in general for general forgiveness of 2025 year, that would be IBR once things are settled.
Okay, thank you. I'm going to talk a little bit about modified IBR. So as we go into the next set of borrowers, what we're calling legacy borrowers. So these are people who have loans, will have only loans that were dispersed before July 1st of 2026. So you've already got all your loans. You're not planning on taking anything else out beyond what you've got prior to July 1st of 2026. If you're a student borrower, you're going to be able to access payee and ICR. Those are two repayment plans under the current rules. And then a modified version of what Carolina was just talking about, the income-based repayment plan. So this is the modified version of this plan is basically the current plan without any income eligibility test, which means that anybody is going to be able to get into it. And you're going to be able to stay in any one of those plans until July 1st of 2028. Comes July 1st of 2028, the payee and ICR plans are going to be phased out. If you're still enrolled in those plans, you would at that point be transitioned to the modified version of the IBR plan. And the IBR plan, by the way, has two different versions of it depending on when your loans were dispersed. And that's what Carolina was alluding to before, that in one of the plans, you would have a 20-year path to forgiveness. In another plan, you would have a 25-year path to forgiveness. And just remember, don't panic if you've accumulated a bunch of credit towards IDR forgiveness in payee or ICR. You're not going to lose that. That's going to get transferred to income-based repayment. Or if you, these borrowers, you will even as a legacy borrower have the ability to apply for the WRAP plan and transition into that plan. Any of that forgiveness credit that you accumulated under these other plans will transition to the new plans. But as Carolina says, in the WRAP plan, you would probably extend the amount of time that you would have to pay by either 10 or 5 or 10 years, depending on which plan you're going from. For Parent Plus borrowers, you must consolidate your loans by July 1st of 2026 and then enroll in ICR or the IBR plan, the modified IBR plan, which previously was not Parent Plus borrowers were not eligible for. You're going to be eligible for that plan, and you might even be eligible for that plan in the next few months. The Department of Education has to tweak their systems to make sure that it accommodates this. But you can certainly enroll in ICR or the IBR plan if you want to retain access to any income-driven repayment plans, and then as a result, retain access to things like forgiveness programs like PSLF. So borrowers who are enrolled in the ICR plan will be transitioned to the IBR plan in July of 2028. So I know that this is for Parent Plus borrowers, the key thing is you must consolidate your loans by July 1st of 2026 in order to continue having access to any income-driven repayment plan. Because as I said in the last slide, new Parent Plus borrowers are not going to have access to any income-driven repayment plans. And then if you're a hybrid borrower, and by that I mean you have a combination of loans that were dispersed before July 1st of 2026 or on or after July 1st of 2026. So one of the rules in the new budget bill is that borrowers have to pay all their loans back in the same repayment plan. So what that essentially means is that if you're a hybrid borrower with some loans dispersed before July 1st of 2026 and some loans that you take out after that date, if you're a student borrower, you're only going to be able to choose the WRAP or the standard plan. So you're not going to have access to the IBR plan because your new loans will not be eligible for that IBR plan, but your older loans are eligible for the WRAP plan. If you're a parent borrower, and this is where it becomes sort of challenging. If you're a parent borrower, you're only going to be able to choose a standard plan. So you're going to have no access to any income-based repayment plan, even though you may have some loans right now that have access to those IDR plans. If you take out additional Parent Plus loans after July 1st of 2026, you will have to pay everything back in the standard plan, which basically means you have no path to PSLF or IDR forgiveness. So that's going to be a whole different can of worms. And we know for Parent Plus borrowers, you probably want to seek some advice on what the best strategy is for funding your kids' higher education going forward. Now, the one exception to that rule is if you have both student debt and for yourself and Parent Plus loans, you can pay in separate repayment plans because those Parent Plus loans are just not going to be eligible for the income-driven repayment plans. So we provided a little chart here that you might, when you get the deck, you can sort of print this out or just refer back to this as a reminder of what the different timelines are and what you can do with the different plans. And of course, if you have any questions, you want to come back to us for one-on-one consultation.
Nancy, can you please go back to the other slide? So there's
Which
no,
slide?
that one's fine. So we're
Okay.
providing a lot of information and like we've
Yeah.
been digesting this information for days now where it makes sense to us, but we recognize that this is a lot and it's overwhelming. So just big picture. The term commonly used is IDR, income driven repayment plan, and that's an umbrella term. Under IDR, there are different repayment plans. Right now, you have no longer can access, but it's safe, right? Like people are in that plan. IBR, pay, and ICR. So just for a little bit of context, you're gonna hear us and you'll see my comments or answers in the Q&A to say if you're looking to switch plans, we want you to pay close attention to IBR. IBR is a type of income driven repayment. The reason being is that that is in statute, and IBR continues to carry the 20 to 25-year forgiveness. By 2028, both payee and ICR will sunset. They will no longer be available. So that is another reason why we say IBR. Now, if you're currently enrolled in payee and ICR, you can remain there if that's the plan that is working for you. Eventually, we foresee you being required to switch. So again, IDR is the umbrella term. There are different repayment plans. A lot of them are going to sunset eventually. Whether you're what we call a legacy borrower or a future borrower, your options are going to be way more limited. For current borrowers like yourself, arguably you would be eligible for IBR and RAP. For future borrowers, you would only be eligible for a RAP. Now, all of you, regardless of whether you're an old borrower, new borrower, you should also be eligible for what we call traditional plans. There's new traditional plans, so to speak, in the formula. So I hope that helps a little bit because I know people are in the Q&A are really confused. I get it. It's like crazy. When you get this PowerPoint presentation, you might want to spend a minute, especially on this chart, just to see how the rules are going to apply for different populations. And it's all dependent on when you borrow. Did you borrow before July 1st, 2026, or do you borrow for July 1, after July 1, 2026? As Nancy mentioned, if you're a Parent Plus loan borrower, we really, really encourage you to reach out to us as soon as possible because it gets even more complicated. We really need to have a conversation with you to give you the pros and cons of what's going to happen, especially if you think you're going to borrow more loans as a Parent Plus loan borrower in the future. Thank you.
And just a reminder again, we are doing a webinar next week that's going to focus more, even in more detail on all of this. So feel free to join us for that. Sometimes hearing it twice helps to reinforce it. But we wanted the focus actually of this webinar to be on default and collection. So I'm going a little bit quickly through this. But we'll make sure that eventually everybody understands it. Okay. Other important updates. Of course, there was the announcement back in April that the Department of Education was going to start collections starting in May 5th. So remember, collections had been paused on defaulted federal student loans uh, since the beginning of the pandemic. And the understanding was that as of the end of May, the department had collected some $100 million. Now, one of the things that they did say back in June, after they made the announcement in April that they were going to restart collections, was that there is a pause on Social Security offsets right now. So there are basically three different ways to make that the federal student loan system makes collections. They either will offset your Social Security, they will take your tax refunds, or they will garnish your wages. Wage garnishment is supposed to happen, hasn't started yet. It's supposed to happen later this summer, where the notices will go out. The actual wage garnishment probably won't happen till the fall. Social Security offsets were supposed to have happened, and we know that some people actually did get notices saying that their Social Security was going to be offset. But in June, the department said that they were going to pause that. As far as we know, that pause is currently in place, but they do plan to resume or start up those collections sometime this summer. They didn't give a specific time. The only thing that we know that they actually are taking right now is some tax refund intercepts. So if you've already filed your 2024 taxes and gotten your refund, it's okay. You're not going to be clawed back. But if you didn't file yet and you're thinking that you might get a refund and you're in default, you could be at risk of getting that refund intercepted. Um, it's anticipated there were about 5 million, 5.5 million borrowers currently in default, and most of those were in default prior to COVID. But there's 5 to 6 million people who are significantly delinquent on their loans. There could be close to 10 million borrowers in default within the next few months, and that's 25% of the total loan portfolio. So bottom line is if you've gotten some of these notices, even if you're in one of these categories where collections haven't started yet, or you're on Social Security and that's paused, you want to take action right now to try to get yourself out of default before some of these involuntary collections hit. I'm just going to say for whoever's raising your hand, if you can please put your questions in the Q&A. I think in order for us to be able to get through this presentation, we're going to have to kind of contain the questions to the Q&A for now. And if we don't get to all the questions in the Q&A, by the way, we will follow up. Okay. So the way you'll be notified, and you may have already been notified, or you may have gotten notices from the Department of Education, the what's called default resolution group, if your defaulted loans are held by the Department of Education, or from a guarantee agency, if you have some other types of loans, you may have already gotten a notice urging you to make arrangements to get yourself out of default. That's not necessarily a collection notice. It's just a notice saying you're in default, you may be subject to collections, you should do something about it right now. Okay, other changes that we've talked about. So the Department of Education workforce reduction, the Department of Education, the administration has basically slashed the workforce at the Department of Education in half. It's probably even less than half at this point. And there was a court order in place to reinstate those fired employees. That court order, I think, was just recently overturned. Those reinstated employees, to our understanding, were never actually working. They were just put back on the payroll. So we're basically back to where we were, which is that there's been a massive reduction in the workforce, and it's really had a significant impact on some of the areas, a lot of the areas within the Department of Education and Federal Student Aid, including the ombudsman that provided help with disputes, some of the technology areas that maintained the websites. As an alternative to filing complaints with the Federal Student Aid Office, which you still should do, if you live in New York, be aware of the fact that New York State Department of Financial Services oversees servicers. Even if they're federal servicers in New York, you can file a complaint with them. And then the Student Borrower Protection Center offered a toolkit for borrowers to start using their elected officials to file complaints. So we have a link to that here. The department also, the president had put out a press release, I think back in February, saying that there was a plan to transition the management of all of the entire student loan portfolio to the Small Business Administration, or the SBA. It's our understanding that they cannot do that without congressional approval, and there was nothing in the big bill that gave them that. Although they're still challenging this in the courts, just what you should know is that if these loans ever do get transitioned to the SBA or anywhere else, nothing should change about your loans. So the balances don't change, the interest rates don't change, the type of loan you have doesn't change, the repayment options, the forgiveness programs that you're eligible for, none of that changes. And we'll talk more about what you can do to make sure you're on top of that later. Recertification dates. So at this point, for all direct and Department of Education held FFELP loans, the recertification of your income-driven repayment plans, which is generally done on an annual basis, but kept getting pushed back because of COVID and then the SAVE forbearance, those recertification dates should be no earlier than February of next year, unless you have like a commercially held FFELP loan that's held at MOHELA or AES. But you want to monitor your accounts and make sure that that's all that you've got the right recertification dates and you're being charged at the rate of an IDR plan and not a standard plan. So what should you do to make sure that you sort of protect yourself and provide proof of what's actually going on with your account. It's very dangerous at this point to rely solely on FSA and servicers to continue to keep accurate records. So what you want to do is download your important information like your loan details from your FSA and servicer accounts, your payment history, which you can find on your servicer accounts, information from the Public Service Loan Forgiveness Tracker, if you've got that from Federal Student Aid, and any important notifications from the servicer inbox. And you want to do this annually, or if you are, sorry, not annually, you want to do it monthly, or if you're ever notified that your loans are going to be transferred. Okay. So Carolina, before we start the next section, which is going to address default and collections, is there anything else we want to talk about?
Yeah, so I've been getting a lot of questions of like, okay, I may potentially need to switch plans or I need to figure it out. What's the best way? What's the cheapest plan? So a couple things. You can always use on student aid, the student loan simulator. You log in and I'll put the link in the general chat. I've been answering it and putting it in the Q&A. The other thing that I want to mention is on studentaid.gov, and I'm sorry to interrupt you, Nancy, this way, but I don't know if you're able to pull up studentaid.gov just for me to show them really quickly. You would have to stop sharing and then
Yeah,
come back to this.
just give me a
But I
second.
think it's critical.
Okay, hold on a second.
Okay, so the question, of course, I'm getting is like, well, wait, what? Or what are my options if I cannot afford any of the IDR? Well, that gets a little more tricky because the alternative are traditional plans, and if your balance is really high, then it might not be cheaper than an IDR plan.
Sorry, I'm having a little trouble finding the right way to share this. Actually, let me stop sharing and reshare.
Yeah. Okay. And sorry for the detour, but I think this is like, if nothing else, this might give you a good tip that I am using a lot with my clients and might be worth you knowing. It's okay. When you log in into your account, so you would be required to log in, we're obviously not logging in. You're gonna go to loan repayment, and then you can use the simulator. You don't have to click on that, but you can use the simulator just to get a sense of all the repayment plans. If you're logged in, automatically it's gonna extract your information, including loan balance. So you could play around with this, go do it. You can put different types of incomes if you file jointly, if you file separately, especially if you're married, you want to run it by jointly, separately, depending on how you file. But what I want to show you is if you go all the way up and go to loan repayment, and then go to income driven repayment plan. So if you're going to switch plans, this is where you would do it. You can do it and you should do it with studentaid.gov. What you want to do if you already are enrolled in an income-driven repayment plan is you would select returning IDR bars and then you would go ahead and click that. You can click on view demo really quickly.
Yeah.
So when you go through this, it's going to ask you basic information. You're going to click continue. You're gonna ask, switch my current plan. And don't worry, you just want to get a sense of what the amounts and the repayment plan options look like for you, right? So you're not going to submit it if you're not ready to make the change. But if you're ready to make the change, then you can go ahead and complete it. You scroll down, you go through this, and then there should be now for most bars, not all bars, because there might be data issues, they are linking your information from the IRS to this application. So you provide approval, and then it's going to walk you through a series of questions. This is a mock one. It will confirm your information. It's going to show your loans automatically. It's going to show you what repayment plan you're enrolled in and the amount. Then you're going to click continue. And then this is where it does the magic of the data matching and all that. Some of data matching continue, right? If you're married and all that, you answer the questions. We'll say no for this purpose. Okay. And I know we're being detailed, but this is good. This is where the data income matching is happening. So you continue, and this is gonna be like doing a little circle there. It's gonna ask you about dependent children and all that. You complete that and continue. Uh, so you file taxes. Yeah. They're going to be using income from the last year if you've already filed your 2024 taxes. If you have not filed your 2024 taxes, they would use 2023 if that's available. If you have not filed taxes in the last 2 years, that's where this might not work for you because they don't have your income. So you continue. We're almost there.
Well, yeah,
Well,
this is
yeah, this is if
if
you,
for some reason it doesn't connect with the IRS database, it's going to ask you to upload proof of your income.
yeah, but this is only, you only do that again if you're ready to complete the application. Then you continue. And then it's going to show you this. It's going to show you the plans that you are eligible for and the amount. Okay. And so this, you can just look at this and figure out what your IBR repayment plan is going to look like. What does it look like with ICR? And if you're eligible for pay, not everyone's going to be eligible for it. For older borrowers, you might not be eligible for it because there's very specific rules of when you had to take out loans and all that. So chances are you might get IBR and ICR, so you'll be able to see it there, right? And then you would select the plan. The reason why I'm going here, and you don't have to review and submit it. Like again, this is when you submit it. You can just stop in the previous page just to see what those amounts look like for you. Now, for the person that said the IDRs are still cost prohibitive, that's when I say use a simulator to see if a standard repayment plan is gonna be cheaper. Usually it's not, but you can try that. Now, if you're changing plans, IDR plans, or applying for the first time, you do it through studentaid.gov. If you're going with a traditional plan that does not take into account your income, you would be doing that with the servicer. You can call the servicer and they can walk you through it. So I'll stop there. I just wanted to let you know that you can actually right now, using your account, get a more accurate estimate of what your payment may look like because the government is doing data IRS retrieval. And that way, you know, like that's what they have on record. Because we have been spending a lot of time with hypotheticals with clients, and it's like, well, at the end of the day, let's see what they have on record. So thank you for that detour. I will go back to answering questions. Thank you, Nancy.
Okay. All right. So I'm going to have to speed through this to make sure we get through it all. So in terms of understanding your loan status. And the reason we put this on here is when the department issued its announcement back in April that they were going to restart collections, they phrased it in such a way that I think a lot of people who just hadn't been making payments for reasons other than not than being in default thought that they were going to be forced to make into collections as a result. So let's just be clear that the only time that you will ever be uh, facing involuntary collections is if your loan is in default. If you're in repayment and you're just making your payments, but the monthly required payment is zero, you're fine. If you're in any form of deferment or forbearance, like the save forbearance, that means that your loans are in good standing. You're not going to be facing collections. If you're in school, not making payments, or in the grace period, you're not going to have to be forced to make collections. If you are delinquent, now delinquency default happens when you are delinquent or miss 9 months or more payments. So if you're delinquent, if you haven't paid in 6 or 7 months, it's not a great thing. You're behind, but you will not be faced with involuntary collections because you're delinquent. Only when you are at least 9 months behind on your payments, generally they probably wouldn't put you into default for another couple of months. After that is the point where you have to worry that you're going to be facing a wage garnishment or a Social Security offset or a tax refund intercept. So how do you know whether your loans are in default? What you need to do is log into your studentaid.gov account. If you're not sure, this is your federal student aid account. You go to the dashboard. What comes up when you log in on this greeting page, if you're in default, you're going to see this little peachy colored, rosy colored, and it depends on how you see color, what color this is, banner, and it's going to say that your loans are in default. And it's possible, by the way, if you have multiple loans, and most people do, you can have some loans that are in default and others that are in good standing. So if you want to know exactly what's in default, you would log into your account, click on the My Aid section, and then scroll down to where you see what's called loan breakdown. It's generally by servicer, and the servicer of defaulted loans is usually going to be the debt management and collection system if you've got a Department of Education held loans, or some guarantee agency if you have other types of loans. And you're going to see for each loan that's in default, you're going to see this little pinkish button. And then under loan status, it's going to say default. And that's how you're going to know whether or not you have loans in default and which ones are actually in default. I would say most people that are in default generally have all their loans in default, but I have seen situations where only some are in default. So who services the defaulted federal loans? As I said, Default Resolution Group manages the Department of Education's held loans. And sorry, that usually shows up on your federal student aid account as the servicer, as default management and collection systems, or default collection and management systems. And that's going to include direct direct loans, or Department of Education held FELP loans, or Perkins loans. Anything that's held by the Department of Education is going to be managed by Default Resolution Group. You can also create an account on myeddebt.ed.gov to get more information about your defaulted loans. If you've got other types of FFEL loans, it's going to be managed by one of the guarantee agencies. And when you get this deck, there are about 12 or 13 different guarantee agencies. You can click on the link. It'll give you a list of all the guarantee agencies and their contact information, but that should also be on your federal student aid account, so you know who to contact. So addressing a delinquency. So if you are delinquent, if you are 6 or 7 months delinquent, or even 8 months delinquent, you still have time to do something to make sure that you don't go into default. So what should you do? You want to call your servicer, and you want to request a retroactive forbearance. So let's say you've been delinquent since May, and here it is July. You would call the servicer and say, "Hey, I want to put this forbearance, which is going to basically put a stop on collecting payments on your loans. It will keep your loans in good standing without you having to make a payment for a brief period of time." And you can try to request that forbearance and have them apply it all the way back to May. They won't always do it, but it can't hurt to ask. Just remember that if you miss 3 payments in a row, that's when they're going to start reporting these things to the credit agencies. So if you ask for a retroactive forbearance, that might clear up any credit issues that you have with being 3 months behind. But at the end of the day, forbearance is only temporary. It's not a long-term solution. So you're going to have to, at that point, review and potentially change your repayment plan, explore all of your options, explore these income-driven repayment options. And if there's really nothing that you can afford, you can look into longer-term deferments or forbearances that maybe will tide you over until you can make changes to your circumstances that will allow you to afford payments going forward. Okay, now what if you're actually in default? So if you go in default and you remain in default and you don't take any actions to get yourself out, you will be facing involuntary collections. And as I said, these from the federal government basically come in 3 forms. So first, there is administrative wage garnishment. And when we say administrative, that means that the federal government can do this without taking you to court. Now, if you have a private student loan, you can also face a wage garnishment. But in the case of private student loans, the lender actually has to take you to court and get a judgment in their favor in order for them to actually take any of your money. That doesn't have to be the case with the federal student loan. It's the federal government. They just send you a notice and then they can do it. And they can garnish up to 15% of your disposable pay. And disposable pay is basically your income less any mandated deductions, things like federal, state, and local income taxes, Social Security, Medicare, any mandatory retirement contributions. That would constitute your disposable pay. By the way, they do have to leave you with a minimum amount of money, so it's I think 30 times uh, the minimum wage, which equates to something like $218 a week, something like that. Um, not what's not excluded in calculating your disposable pay are things like health insurance premiums, union dues, any voluntary contributions to retirement. And so the garnishment is going to continue until the debt is paid or resolved. And we'll talk about how to resolve and cure your defaults up a little bit later. And your employer is going to be required by law to withhold those wages. So you obviously, most people really want to avoid wage garnishment. It can strain the relationship between the employee and the employer. It's just not a pleasant thing to have to discuss with your employers. The process is that the borrower should receive a written notice at least 30 days before the garnishment begins. And the department has said that those garnishment notices should go out later this summer. And then you, as the borrower, have a right to request a hearing. And you can challenge the garnishment based on financial hardship, based on the loans actually not being in default, or an incorrect debt amount, and maybe a number of other issues. The key thing is that you want to respond and request that hearing within the time frame. You can still do it once the wage garnishment starts, but it becomes a little bit harder. And then, of course, it's not going to stop the wage garnishment immediately. So it's always best to respond to those hearing notices right away. The other ways the government can take your money is through the Treasury Offset Program. So that's where the Treasury is going to withhold certain federal benefits, and those include Social Security, retirement, and disability, um, federal employee salaries, military benefits. They can also, as we've discovered, intercept the sale of any federal assets that you may have, or monies that you might receive as a result of a federal contract. All of this apparently can happen with very little notification through the Treasury Offset Program. In terms of the offset rules for Social Security, they can garnish up to or offset up to 15% of your monthly Social Security benefit or your SSDI benefit, or the amount by which your monthly benefit exceeds $750. So they have to leave you with $750 a month, which, as you can imagine, is just extremely difficult to live on. So if you've got defaulted federal student loans and you're receiving Social Security, you've got a little bit of a cushion right now since they paused the actual collections. You want to contact us or contact somebody and try to get out of that default before those collections start up in the next couple of months. In terms of the offset process, the loan is sent to collections via the debt management collection systems. And by the way, we're kind of going back to older offset processes. This is a kind of a new environment. The processes may change a little bit. We're kind of monitoring that to see. We haven't seen a lot of these notices just yet. So this is subject to change going forward. But this is what's supposed to happen: is the Treasury Office is initiated, a notice is sent. The only ones that I've seen so far, the notices are coming from the Treasury Department itself. And then if you do nothing, the government was then going to either intercept your tax refunds or take your Social Security. There is a phone number that you can call. It's called the Treasury Offset Program, or TOP hotline number. This is the 800-304-3110 system. It's an automated system where you call it and you just give it your personal information, your name and your date of birth and Social Security number, and they'll let you know whether or not you're on a scheduled list of offsets. Tax refund intercepts, the government is going to send you a notice, and I believe they only have to send you one notice. So if they sent you a notice 3 years ago that your tax refunds are going to be intercepted, you may not get another one. So the things that they can do is they can take your tax refunds. They can also intercept things like the earned income tax credit, child tax credit. But it is important to know that if you're married and you're filing your taxes jointly, and your spouse is not subject to the intercept, but they take the entire refund, you can file, or your spouse can file a separate form to the IRS to get their portion of the refund back. Additional consequences to being in default. So you have no access to new federal student aid if you're planning to go back to school. You don't any longer have access to income-driven repayment plans. You don't get credit for loan forgiveness programs. And of course, it's going to damage your credit history. And of course, the longer you remain in default, you risk the collection fees and added interest piling on to the size of your debt, making it that much more difficult to pay the loan off in the longer term. How to contest an offset or a garnishment. Again, we talked about requesting the hearing promptly, the grounds that you can dispute the offset on, and making sure that you have the proper documentation. So if you're contesting on the basis of a hardship, you want to include things like proof of income, proof of your expenses. If you're contesting based on the fact that you don't have defaulted loans, you want to submit proof that your loans are in good standing, showing your federal student aid account or your non-default servicer accounts, and things like that. And of course, you should always reach out for help if you're in this situation. Getting out of default. Let's see where we are in terms of time. The good thing about the federal student loan system is that there are ways to get yourself out of default. There are two options. There's a loan consolidation and loan rehabilitation. Consolidation tends to be a little bit quicker. Actually, tends to be a fair amount quicker. It can be done generally in 2 to 4 months, whereas loan rehabilitation requires that you make a on-time monthly payment, 9 on-time monthly payments over a 10-month period. The whole process generally will take 10 to 12 months before it can get yourself out of default. And these are just generally speaking, loan consolidation can be cheaper and faster. But not everybody is going to be eligible for loan consolidation. Not everybody's going to be eligible for rehabilitation. So you have to see what fits there are other considerations which we don't have time to go over right now, but you want to kind of discuss this with a counselor to make sure you understand what the best, most expedient option is for you to get out of default. Just a quick word about consolidation. If you have an outstanding wage garnishment, you cannot consolidate your loans unless you're able to get that wage garnishment set aside. If you do have a wage garnishment, you can do a rehabilitation, and the rehabilitation would stop the wage garnishment after 5 months of qualifying payments. Some of the key considerations before getting out of default is that look at what the payment amount is going to be when you come out of default. So post-default payments in an income-driven repayment plan may not be the same as maybe what you were paying through the loan rehabilitation process. Could be a little bit more expensive. So you want to make sure that you understand that that's what's going to happen, and that prepare yourself and make sure that you can afford those post default payments. Understand what you have to do to manage your loans and keep them out of default once you get yourself out of default. So that means if you're on an income-driven repayment plan, you need to recertify those plans on an annual basis, and just make sure that you're up to speed and making your payments so that you avoid defaulting for a second time. Now, there are limited circumstances, and we generally don't recommend this, but there are limited circumstances where it may make sense to stay in default versus coming out of default, because you are going to be charged less in default than you will if you come out of default. But this is very specific circumstances, and you want to discuss this with a counselor before you make that decision. These are I'm not going to go over this in great detail. These are of course, key to staying out of default is choosing the right repayment plan going forward. You generally have 2 different options, 2 different ways to pay back: a standard plan, which doesn't generally offer forgiveness, and where you're just paying the loan back based on the size of the debt, the interest rate, and a predetermined payment a period, which is like paying back any kind of consumer debt, or these income-driven repayment or IDR plans that are going to either offer forgiveness after 20 or 30 years, or would give you credit towards public service loan forgiveness, which provides forgiveness after 10 years, cheaper payments, more flexible in the payments, but a little bit more difficult to administratively maintain because um, you do have to recertify them on an annual basis. The current traditional plans right now, by the way, are standard, extended, and graduated. Of course, the extended and graduated are going to go away once for new borrowers after July 1st of 2026. Also, if you see level plan on your servicer account, that would also be a traditional plan. And then the income-driven repayment plans right now would consist of income-based repayment, pay as you earn, income contingent repayment, the save plan, which nobody new can get into. And then starting next year, the RAP plan or repayment assistance plan. Quick word about the IDR account adjustment. This was a one-time account adjustment that that the Biden administration provided to borrowers to give them retroactive credit towards income-driven repayment forgiveness based on a set of relaxed rules. Now, that's a lot of wording, but basically, the IDR forgiveness program had not been functioning properly for many, many years. The Biden administration put this plan in place to give people credit for periods that they would normally not get credit for. There was a tracker on your account earlier this year. It was taken down, but that information, if you have direct or Ed held FFELP loans, is still on your account. And this is the way to retrieve it. What you would do is you would log into your federal student aid account. You would open up a separate tab in the same browser that you're logged into, and then you would input this link that you will have when you get this deck. And you're going to see this ugly looking file over here on the right. It's going to have a little box at the top that says pretty print. You want to check that off, which is going to make it, frankly, if you didn't check that off, it would be less legible than what you see right here. And you want to download or copy and paste this information into a file and save it. Even if you can't read it, we can. It's going to give you some indication and information about how much credit you accumulated towards IDR forgiveness through the IDR account adjustment. And remember, whatever plan you accumulated these payments for, if you switch plans, those payments would accrue to the next plan. And then I think this is right at the end. Finally, just understand that there are basically three strategies for tackling your debt that most borrowers fall into, which is either pay the debt in full as quickly as possible. So that's if you have a high income in comparison to your loan balance, you can make more than the required payments or lump sum payments, and just pay the debt off. The faster you pay it off, the less you'll pay in interest. The middle portion is where most of our clients sit, which probably where most of you sit, which is identify some forgiveness program that you're eligible for and make the minimum required payment until such time as you've earned credit for that forgiveness. And then the last bucket, which is pay the minimum required until death do you part. This is generally going to be for older borrowers who maybe have taken out late in life loans for themselves or Parent Plus loans, and they're either close to or at retirement, so they're not really able to take advantage of things like PSLF, and they are just resigned to the fact that they're going to have to pay for 20 or 25 years, which if you're 50 or 60 or 70 could be the rest of your life. The reason that we put this on here is that unlike most consumer debt in this country, federal student loans are dischargeable in death, which means that they do not accrue to your estate. And so it will never be a burden on your loved one to carry on your debt obligation. So if you're in this situation, you just want to find the cheapest repayment plan, make that payment, and just know that when you pass, this is not going to pass on to your kids or your beneficiaries. And that's it. So I know we're a little bit over, but Carolina, if there are any last minute questions, actually, before I turn it over to you, Carolina, just one last thing. When you get this deck, if you haven't already done so, at the very bottom here is a link to our EDCAP newsletter, which you can subscribe to for free to just keep you updated on latest developments. And then if you do want to contact us for an appointment, these are the ways that you can do it. by phone, by email, or by just booking an appointment online.
Okay. Thank you, Nancy. I do want to echo something, and that is there were a few questions about public service loan forgiveness, and that program is still intact. The requirements are still the same. There's other potential changes down the line about who is a qualifying employer, and that's going through the negotiated rulemaking process that will likely be challenging court. The message is that if you work for a government nonprofit agency and are looking to get your loans forgiven through PSLF, the big key is for you to file your employment certification form or forms using the PSLF help tool. And the reason why you want to do that is because when you file that form, that generates a tracker, and then you can see how many qualifying or eligible months you have towards the 10 years required. I just put in the
And,
chat
and
the
request an electronic signature from your employer when you do
yes,
that.
when you use the PSLF help tool. I put the link in the chat. Someone is asking, is IBR going away? No, IBR is staying. Future borrowers, people who borrow after 2026, are not going to have access to IBR. But if you're a current borrower, not going to borrow more, you should have access to IBR. IBR is staying. In fact, that's the only plan that it's going to end up staying, right? They're going to get rid of SAVE, they're going to get rid of PAYE, and they're going to get rid of ICR. The new RAP plan is not available. Someone asked, how come I don't see it on my studentaid.gov account as an option? That's not going to be available until next year, July 1st, 2026. Could it be available a little bit earlier? Maybe, but unlikely. It takes time for them to develop all these payment plans and implement them. So be aware of that. Again, IBR is not going away. It's probably the one plan that is surviving from the current structure of IDR plans. Thank you. And I put our contact info. If you need help, you can find us, book an appointment, as Nancy mentioned, through our EDCAP website.
Okay. Well, thank you, everybody. I know that was a tremendous amount of information. We're happy to follow up with you with if you have questions. We look forward to hearing from you in the future.